Imagine you're analyzing the Euro USD chart and suddenly the RSI dips below 30, indicating an oversold condition. Thinking it's a signal for a price reversal, you decide to buy the Euro USD and go long. However, the price continues to drop and you get stopped out. Frustrating, right? Stay tuned to discover how to use the RSI effectively and avoid such pitfalls. Welcome back to Financial Flow Channel, your go-to destination for trading and investing. If you're passionate about enhancing your trading skills and navigating the markets with confidence, you're in the right place. Don't forget to like this video, hit that subscribe button, and ring the bell to never miss a future content. Your support is greatly appreciated and helps me continue creating free content like this. Stay tuned until the end of this video, as I'm going to reveal the ultimate strategy to use the RSI indicator and significantly increase your chances of making profitable trades. You don't want to miss it. So let's now explain, what exactly is the RSI, and how can we use it in order to make profitable trading decisions? The Relative Strength Index, RSI, is a momentum oscillator that measures the speed and change of price movements. It's like a speedometer for price action, providing traders with insights into overbought and oversold conditions. The RSI oscillates between 0 and 100, with readings below 30, indicating oversold conditions, and readings above 70, signaling overbought conditions. It's important to note that the RSI can behave differently in trending and ranging markets. During a strong uptrend, the RSI might remain overbought for extended periods, and during a strong downtrend, it might stay oversold. Therefore, considering the overall market conditions when using RSI is crucial. We will examine real examples to clarify these concepts further. The standard setting, and the one I personally use for RSI, is the 14 periods. But traders can adjust this based on their trading style. Shorter periods will make RSI more sensitive and might lead to more signals, while longer periods will make RSI less sensitive, potentially leading to fewer but possibly more reliable signals. Let's explore how to use the RSI in various trading scenarios through real chart examples. First, we will talk about the trend continuation trading. During periods of strong momentum, indicated by an RSI above 70 for uptrends, or below 30 for downtrends, it can signal trend continuation. Traders can use these periods of high momentum to enter trades in the direction of the trend, expecting the strong momentum to continue. We have two scenarios of trend continuation trading: the bounce from the 50 level and then the continuation, and the bounce from the 30 level in an uptrend or the 70 level in a downtrend, and then the continuation. I'll show you two examples of trend continuation trading. Let's examine the first example. When an uptrend is already in progress and the RSI climbs above 70 before retracing to approximately the 50 level. At the same time, the price action touches the trend line on the chart, leading to a confluence of the uptrend, trend line bounce, and RSI setup. Subsequently, as both the price and RSI begin ascending, a strong setup for trend continuation trading develops. So, I initiate a long position, placing a stop loss below the nearest swing low, approximately 15% from the entry point. For the take profit, I implement a 2-to-1 risk-to-reward ratio for a 30% gain. Eventually, the price reaches the take profit target, yielding a 30% profit. Although, if you see the price later increased by over 500%, while we only targeted 30%. It's essential to remember that strategies for profit-taking, stop-loss placement, or trailing stop-loss should always align with your trading style and preferences. I can help you with that as well. On the next video, that will be about the correct way of setting a take-profit target, stop-loss level, and how or when to trail your stop-loss to achieve profits like 500%. So, subscribe to not miss out. Let's check out the second example. In this scenario, we observe another uptrend. Subsequently, the price decreases, and simultaneously, the RSI falls below 30, as opposed to the 50 level in the previous example. This coincides with a confluence at the support area. If you don't know what a support or resistance area is, check the video here, or after you finish this video. The link is in the description below. So, I wait for the price and RSI to bounce back up before making a move. When the price bounces up and closes higher than the previous candlestick, I buy, setting the stop loss below the support line and the previous wick of this candlestick, with some extra space for safety. This time, the stop loss is at 10% and I aim for a 30% profit, giving me a 3-to-1 risk-to-reward ratio. Eventually, the price hits the take-profit target. Now, let's move on to the next scenario of trend reversal trading. The RSI can also be used to identify potential reversals. When the RSI crosses above 70, it may indicate that the asset is overbought and a price drop could be imminent. Conversely, when the RSI crosses below 30, It may suggest that the asset is oversold, and a price rise could be on the horizon. Let's see another real trade example. On this 4-hour chart, we're looking at the British pound USD currency pair. It's clear that there's an uptrend, but we're anticipating a change in direction and aiming to go short. We've identified a resistance area on the daily time frame, which previously acted as support. Returning to the 4-hour chart, we notice the RSI climbing above 70 after an extended uptrend, but it's still quite distant from our resistance level. We patiently wait for the price to approach or reach the resistance area. After a few days, the RSI surpasses the 70 level once again, coinciding with the price reaching the resistance area, creating a confluence of resistance and RSI above 70. Upon observing a strong bearish candlestick, we initiate a short position, setting the stop loss approximately 3% above the resistance area. For the take profit, we refer back to the daily time frame and identify a consistent price level that the market tends to retest before bouncing back up. We draw a support line there, and we set the take profit at around 14%, resulting in a risk-to-reward ratio of 5-to-1. After a period of time, the price reaches our target. But how do we know if it's a trend reversal or trend continuation signal? We can use something called RSI Divergence Convergence to help us out choosing the right decision. Divergence occurs when the price of an asset is moving in the opposite direction of the RSI. For example, if the price is making higher highs while the RSI is making lower highs, it could indicate that the upward trend is losing momentum and a price drop may be coming. And convergence is when they are moving at the same direction, indicating a strong momentum on the price. Traders can use divergence convergence signals as early warnings of potential trend shifts or trend continuations, allowing them to adjust their trading strategies accordingly. We'll analyze a trade example to better understand how to interpret divergence convergence signals. Once again, on the 4-hour chart of British pound USD currency pair, we observe the price encountering a resistance area, while the RSI surpasses the 70 level. We patiently await confirmation, seeking a higher high in the price and a lower high on the RSI. After some time, this confirmation occurs. Notice the price making a higher high while the RSI makes a lower high, signaling a loss of momentum. With this confirmation, we enter a short position after observing 2 subsequent candlesticks. The stop loss is placed above the resistance area, and the take profit is set at the same level as in the previous example, resulting in a risk-to-reward ratio of 7-to-1. Once again, the profit target is reached, resulting in a 14.5% profit. In contrast, convergence requires a higher high in the price, along with a higher high in the RSI, or a lower low in the price along with a lower low in the RSI. RSI convergence is primarily utilized for trend continuation trades. We'll explore an example of convergence as part of our discussion on multiple time frame analysis. Let's now talk about all these methods by combining multiple strategies for a more reliable trading plan. One effective trading strategy involves using multiple time frames to confirm the trend and make trading decisions. This is where the saying, "the trend is your friend," comes into play. For instance, if the weekly and monthly charts are showing an uptrend, you may use the daily chart to find optimal entry points with the assistance of the RSI. Alternatively, you could combine the daily and 4-hour charts to identify favorable entry points on the 1-hour chart. This multi-time frame analysis empowers traders to align their trades with the dominant market trend, often leading to more favorable outcomes. Furthermore, integrating the RSI with other technical analysis tools and price action, such as support and resistance areas, trend lines, multiple time frame analysis, and divergence convergence patterns, adds another layer of confirmation to your trading decisions. Think of it as a checklist, where each indicator reinforces the significance of key levels and provides additional validation for trade entries or exits. By cross-referencing RSI signals with these technical indicators and price action, traders can make more informed and confident decisions, enhancing their overall success in the markets. Let's see the final example. To determine the overall trend direction, we rely on a 100-day simple moving average and identify significant highs and lows on the chart. Examining Apple's monthly chart, we observe the price positioned above the 100-day SMA, accompanied by the formation of new higher highs and higher lows. Confirming this uptrend, we check the weekly time frame where we confirm the bullish trend. Transitioning to the daily chart, we might have a potential trade setup. Oh, and by the way, if you haven't checked the moving averages video, check it up here or in the description. Here we identify a low on the chart followed by a higher low, On the RSI, we observe a low followed by a higher low, indicating RSI convergence, a bullish signal. We also have a trend line here as an extra confirmation. So what do we have in our checklist? We have identified the overall trend, we have a trend line bounce, we have RSI convergence, so we are good to go. The following day, we initiate a long position after the RSI crosses above the 30 level, and the first green candlestick closes. Placing the stop loss below the previous low, we set a 20% take profit target by identifying a nearby resistance area upon zooming out. A few days later, the take profit target is achieved. While the RSI can provide valuable insights, no indicator is perfect. Traders should always use stop losses and consider the risk to reward ratio before entering a trade. This is an essential part of risk management and can significantly impact your trading success. The RSI is a versatile tool that can significantly enhance your trading strategy if used correctly. Whether you're using it to identify overbought and oversold conditions, spot potential reversals, or confirm support and resistance levels, mastering the RSI can provide invaluable insights into market dynamics. Have you used the RSI in your trading strategy? Share your experiences in the comments below. In our next video, we will be talking about the correct way of setting a take profit target, stop loss level, and how or when to trail our stop loss. So stay tuned. So that's the end for our comprehensive guide to the Relative Strength Index. If you found this video insightful, don't forget to give it a thumbs up and share it with your trading buddies. Stay tuned for our next video. Until next time, happy trading.